What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 7th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, I want to spend some time to focus in on a very important topic, and that is a potential liquidity shift from traditional markets into cryptocurrencies, predominantly in stocks and treasuries. Now, as we've talked about, we've not only seen as of this week how the currency manipulation in China, as well as fears around the trade war, have fueled the rise for Bitcoin. And I think we're going to see a phase 2 of this. We're going to see a continuation of this liquidity shift into Bitcoin that could prop us up back to 20,000 and really prepare us for an environment to go into the next cycle to all new highs. So we've got lots of things to discuss, guys. Let's not push it off any longer right after our quick sponsor.
We at Paxful believe that everyone should have a way to pay bills, purchase goods, send money, and build your own business with Bitcoin. On Paxful, there are more than 300 ways to buy and sell Bitcoin. Be part of the peer-to-peer community. Create an account today.
Alrighty, so let's go ahead and get started by taking a look across the board for the market, guys. The general market for cryptocurrencies is down at the moment. However, we do have a decent amount of cryptos that are currently outpacing Bitcoin at the moment on this downward turn from the upside here. We can see here as well, if we take a look at overall market capitalization, again, we've basically just been stagnant at the moment. Nothing too severe, about $6 billion down from our relative peak here on the recovery rally. Again, I think we are in the exiting of the accumulation phase. Even if, for example, we're stagnant for another day or two, I think we're going to press out of the wedge relatively soon. Reason being is that the macro environment's there. We have yet to really see any kind of crazy volume coming yet. So I think if we get a good breakout day above the line of resistance as we're pricing up close to it, I think it'll be enough to continue the spark for continued upward momentum. And if we take a look as well at Bitcoin dominance, Bitcoin is just absolutely claiming the dominance chart right now. I think you've got an easy 2% here upwards towards 70% in regards to Bitcoin gaining dominance. And that might mean we get an exit out of some altcoins in this case, or at least a decline in altcoin valuations. But again, I don't know, we might see some new liquidity entries. Now, the reason I'm kind of keeping confident on this, I talked about this line of resistance we have to keep in mind, as well as with the potential line of support that we could spot price on, which is from the Fibonacci fan here, is up here. For example, we have the line here from the peak here, a little bit below 14,000, that is lined with the second point of resistance. So as we can see, it did apply some resistance yesterday. Price was not able to close above there, but we also aren't getting a dramatic sell-off. The only thing I would worry about is if we get a rejection today and start to turn this into a red day with a lower level than what we saw yesterday. That would signal to me that we're probably going to come back down to the upper $9,000 range and then going to bounce out of it. But the wedge is already getting quite tight, guys. And again, I've emphasized a lot, the major point that I've taken away from this market is to not try to trade it, and also not try to get greedy and trying to get like the best low prices. I believe anything in this range is going to be a huge discount a few weeks out in this case, when we really start to pick up on the cycle and possibly go up to 15,000, 18,000, 20,000. I think that's where we're going to in the sense of the cards that we have right now. And the reason for that is because the macro environment is brewing for that. I think Bitcoin is becoming a much more mainstream topic of discussion when people, for example, in the financial sector, are taking a look at what's happening in China, as well as the United States and in Europe and Japan and all these markets, and we're starting to see some very stark movements. The worst day in U.S. stocks in 2019 happened in a matter of a very short period of time, and we're seeing that the only good performing assets are gold and silver, which are very well known, historically time-tested assets, and Bitcoin, interestingly enough, and other cryptocurrencies, of course. But Bitcoin is obviously the face. It's the topic that everyone's talking about, and it's the most well-known cryptocurrency, and it's been the longest standing cryptocurrency. So when we have to understand the kind of psychology here, guys. It's not much more complex than thinking about a bunch of people who for years have been speculative of this asset, and now we're seeing that as China deeply devalues its currency, almost nearly 2% in a day, the entire currency supply, crazy enough. At that same time, this other no-name Mad Lag coin is up 10%. And that's what we got the other day, right? So this gets people talking about it. It gets institutional interest. It gets efforts in the regulatory environment to push for things like a Bitcoin ETF to open up new liquidity gates for this market and get exposure. Because not only do private investors want access to this, they know that their clients want access to it. And as stocks start to top, trading revenues dry up. These companies run off business models, guys. They need to get exposure to these asset classes, both for themselves and for their clients. And that's exactly what we're going to have here. So again, as we talked about, stocks back a few days ago had their biggest plunge of the year. And these are the time periods where people start to look for hedges and serious liquidity exits out of the market. We can see here, even though we don't have the full Bloomberg article, that over $700 billion was wiped in market capitalization. It's almost $1 trillion in a day. That's when serious money starts to come out. This is my face when I'm like told by someone that, you know, hey, Nick, you should buy stocks at the top. And I'm like, nah, I'm good. I'm a swing trader. Love that guy's like smirking, just having to catch a really funny photo. But anyways, I digress. The major point here, as I've talked about, is that whereas some people, for example, this is actually really another good Bloomberg article and video piece that I want to refer to in a positive nature and saying, a lot of people are talking about buying the dip in stocks. I'm not really focused on buying the dip in stocks. I'm much more interested in the correction that we've had in Bitcoin and the still, you know, left room to regain back to the previous highs this year, because I love the momentum of this asset. The best winning traders, I've learned this from a lot of people I've met, from one of my friends, Dr. Chris Catcher, who we had on the Dashcast, and all kinds of traders who I really admire, and that is, let your runners ride. Do not bet against those who have been performing. Get rid of the ones that are underperforming. I must be sending you some clear signals if, you know, for a year and a half, stocks haven't set new highs. Maybe they did press slightly new highs, and then they're really giving them up very quickly, as we've seen time and time again. That shows that there's fundamentals that are either starting to come into play and starting to show weakness, or it's just that the liquidity is drying up, if you want to put it in more simple terms. We're not getting new buyers coming in. Whereas in Bitcoin, we're getting that. And I mean, the correction didn't even last that long. It's crazy to think. But one thing I did like about this article, to prove to my point as well, as we're building into this discussion of, you know, Bitcoin becoming a more mainstream topic, on Bloomberg, one of the most respected financial media outlets out there. I got to say, out of any mainstream media, you know, company out there, guys, listen to Bloomberg. I mean, there's so much noise out there. When it comes to financial news outlets, Bloomberg is a great monetization model where it makes really quality content, and it doesn't, you know, its content doesn't get interfered with its ability to make money. It sells its, basically makes money through selling its service through the Bloomberg terminal, which is giving access to data, which is even awesome. It's actually, it gives a lot of interesting data sets for traders. Anyways, the major thing here is that in this interview, one of the individuals from JP Morgan, Hugh, actually was talking with the interviewer, and they actually brought up Bitcoin in this use case of hedging against not only currency devaluation in China. We know that there's a huge overexposure in Asia, but predominantly as well as a hedge against the trade war and kind of the general fears that have been growing. I mean, these are just a few things, guys. This is something that really happened over the last week, and the trade war has been something that's happened over the last year or two, but there's so many other macro things that are starting to come to the equation. And a month ago, you know, again, feeding into this whole idea of Bitcoin becoming a growing hedge, Powell even mentioned it, a speculative store of value. The Federal Reserve Chairman, I mean, that's a huge milestone, guys. 10 years out from Bitcoin being created, I mean, we have seen immense growth in this store of value. And to see someone like the Fed Chairman of the United States stating that, even if he labels it as speculative, that is incredible in my mindset. I mean, again, you guys might have differing opinions. You might think, 10 years, it's taken too long, or yeah, him saying that isn't that significant. I think it is, because when investors hear that, they say, okay, wait a minute, hold on one sec. It's a similar store of value, similar to gold, a multi-trillion-dollar asset class. I think most people who are actually using half of their brain would realize, oh my gosh, if the Fed sees this, then what's going to happen when this is in everyone's portfolio, when it's 1 or 2% of their assets that they hold? That's the thing I'd be thinking about. Now, I want to talk a little bit about the performance in equities here. Now, I do want to adjust this chart here. Seems like it got thrown off a little bit. I want to take a look over the indices, because as I've talked about, at the beginning of the video, I think we're going to get a phase 2 to this, guys. I don't think the stock market sell-off is over right yet. And trust me, I like buying dips like this. I love buying these kind of significant dips that close down in a month and a half with the price action. But this formation is looking too concerning to me. And I don't think we're going to get NASDAQ 20,000. I don't think we're going to get, a continued crush of the all-time highs unless the Fed comes out immediately before its next meeting and talks about rate cuts, right? Because even if they can hold out here, let's say the current tariffs aren't bad enough, or if there isn't already enough global concern, the issue here is that we can keep slapping more tariffs. A lot of these issues can continue to brew. I mean, that's the problem here. And, again, I think the tariffs are just kind of an automatic thing that we could just keep making worse and worse and worse to keep rates lower and lower and lower. And I'll be honest, I don't know when that appetite will be satisfied for Trump in that case against Powell. That's a really big question. But anyways, putting that aside, the technical formation of price action tells me a lot. I mean, you just take a look here. We just barely bounced off here on the 200-day. And again, are holding slightly above what I would say is the general support line between the two past forms of support. And if we take a look at some of the other indices, some are less fortunate. The S&P 500 currently seeing this line of resistance, this line of support, general support, as new resistance, unless it can close up above here today. Now, again, we'll have to see how the markets open, but I would say that, again, guys, I don't think you're going to get a crazy amount of buyers here. And for those who are buying up here, there are those who are speculating and buying a market top. I really do not see enough fuel to really press this back up here. This is an ascending wedge on all three indices. Doesn't matter what you look at, even if you consider it holding support here and maybe even bouncing back up, it's an ascending wedge, and the price action range is getting very tight. It's going to start coiling as it's already started to do. And that, to me, is not a really good formation. I'll give you one of my favorite charts, though, to look at, guys. We put this out in the newsletter. We've talked about it a few times over the last few months. And again, it continues to scare me. And that is the Russell 2000. A lot of people do not look at the Russell 2000. It's one of the kind of lesser known indices, but it is one of the still major ones in the United States. And the Russell 2000 is a mixture of 2,000 small cap stocks. So in a bull market, the Russell 2000 does very well in most general cases because you're dealing with a lot of small caps, high risk, high reward, right? That's the general philosophy. And man, dude, during the bull market, I made some good money on some small caps, some mid caps. That was my favorite sweet spot. I loved playing in that range. But it appears now that anything that's going up in this market that might be pushing the indices a little bit higher from the NASDAQ to the Dow Jones, it's not the small caps. It's the large caps in this case. And we can see that right here. We have been getting consistent resistance as we've seen historically. Back here, we had a general amount 3 times here, that to mention as well, 2 times here back between March through May. And I wrote in the newsletter, I literally left my chart like this and I said, third time's the charm, right? And yet again, we got knocked down. That's the whole point here, guys. It's like I had serious confidence that we wouldn't pass it, and look where we're at now. We're right back down here to where we were back in May. It's as if everything just got wiped off just like that, all that potential, recovery. So this is the kind of stuff we should look for, guys. When people are going off of risk, you can look at indices like the Russell 2000. You can see it in plain sight. The valuations tell us this. It shows us that liquidity is not going into risky plays. Well, that means people are going into a risk-off narrative. So they're going to look for hedging assets. And if we take a look at gold, again, piercing up, even with stocks recovering, look at this rally, guys. Pressing $1,500. We haven't seen these levels since back in 2013. To put that in perspective. Silver markets. Take a look at silver. Popping off here just like it needed to do off of the line, the descending line or descending parabolic line of resistance. We are pressing up higher towards $17 an ounce. Again, haven't seen this back since 2018. And if we take a look at the gold to silver ratio, this to me is looking like a clear reversal here. If we take a look at the weekly, I mean, this looks like we set a top, meaning that silver markets are a go. They're going to outpace gold, I believe, in the next few months. And this means that we're going for a precious metals bull market. We are in the trend, guys. This is the time you guys have been probably waiting for years. I don't want to tell you guys what to do. I'm just saying if you've been a precious metals bug, if you like me, have been eager to see that fundamental shift come into play, we're seeing it now. This isn't the time to get bearish on hedging assets. This is the time. The markets are finally making the shift. And how long is, this shift going to last? Are we stepping into a full-blown recession yet? I don't want to claim that just yet, right? But we have so many things under the surface, potential dominoes that could just tip right over. There's so many things. And the funny thing is, the ECB now, at a time where the ECB is dealing with a variety of its nations in negative interest rate territory with trillions of dollars and negative yielding treasuries, which, might I add, as I talked about in my last episode, said maybe next month we could reach 15 trillion. We just reached 15 trillion yesterday. That's probably not even including the amount of treasury notes that are actually negative yielding as well due to the fact of inflation. So what they're getting paid out is a positive rate on their treasury notes. They're not even keeping up with inflation in that case. So I would assume that number is even higher. But as this continues to spread, the amount of negative yielding bonds in European markets, the ECB comically enough says, oh, we're going to start surveilling cryptocurrencies. Oh, we need to make sure to have a good oversight on this. I think it speaks to some weakness. They're not trying to monitor criminal transactions. They want to control this technology. They want to make sure they have a decent amount of oversight, that they're going to tax the hell out of it. They're going to be monitoring the hell out of it. And they're going to make sure they have as much control as possible regulatory wise as you enter into this fearful period, because I think they know something's very wrong when $15 trillion worth of debt is negative yielding. And they have a lot of that debt in the Eurozone. I tweeted out yesterday that this is going to go down as one of the most significant monetary policy experiences in the world. And I'm not the only one who said this. Some of the biggest names in finance have pointed to this, from very, I think, admirable people like Ray Dalio, who is, managed Bridgewater Capital, to even more of the conspiratorial families like the Rothschilds. They've been talking about this since 2016. They've known about this stuff ahead of time. It's very concerning. And again, I think, we've just got an interesting opportunity here, guys, with this new emerging asset class. I think the volume hasn't really even kicked in yet. We've had pretty minimal volume over the last few days. I'm curious what happens when real liquidity shifts in. What's that going to do to price? We'll have to see, guys. Anyways, another macro rant, guys. As always, I appreciate you all hearing me ramble. If you like the rambling, drop a like. It's free, doesn't cost anything. But as well, if you guys want to say something on what we talked about, whether you agree or disagree, leave in the comments down below. Get that discussion going in the comments. Always love hearing from you guys, and I'll try to answer any questions that you might have as well. If not, someone else in the community can help step in. That being realized, thank you all so much for watching. I hope you guys are having a great Wednesday wherever you are. I hope you guys are hedging well, and I'll see you guys in the next video. Stay tuned.